Welcome to the Wiser Weekly Wealth Management Roundtable. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom are my co-hosts, Brad Lyons and Matthews Barnett. Hey, guys.
Hi, Casey.
How's it going?
We are doing our first Two View In, Me Out podcast. So hopefully this is going to work out great. Right now I'm in warm, not so warm, Valdosta, Georgia. It's been a lot cooler than it's supposed to be. Anyway, this topic today is covering 4 ETFs that everyone should have in their portfolio. And there's different variations of these ETFs, and it doesn't have to be the exact ones, but really just 4 ETFs that we should see in everybody's portfolio for diversification. Why don't we start off with that in this conversation is why is diversification so important? We see a lot of portfolios from a lot of different people. And those portfolios are always a little disorganized. We might have someone's favorite stock picks. We might see a portfolio that has random mutual funds in it that are really all the same. I think that's pretty common for large cap funds. They own 4 different large cap funds, think they have diversification, but they have diversification in managers maybe, but not actual diversification in funds or investments. So, Brad, maybe you start us off. Why do we need a diversified portfolio? Why don't we just all put it in 4 stocks or 10 stocks?
Well, it's a good point that you make, Casey, when you say that. We see a lot of investors' portfolios that are somewhat, and I thought you were kind when you said disorganized. That was a very kind word. Quite frankly, they're often a mess. And the reason is because investors will buy a security based upon a recommendation that somebody may have given them or that they came up with on their own, but they don't really know how to value that security through its period where it comes to full valuation and when it's time to sell. So we see very little selling in portfolios. We see a lot of purchases that have been made. A diversified portfolio constructed by an investment professional, the most common thing that it is done is that it starts out with an objective. And the objective is a return number that's required in order to achieve the objective for the portfolio. And then the return number is broken down into asset class returns that are projected using long-term capital market assumptions, using different asset classes. Now, an asset class is a group of financial instruments that exhibit similar financial characteristics. So they're grouped together by similar characteristics, behaving in a similar manner during similar periods. And those have expectations and predictions that can be made. When you look at stocks, you look at bonds, and you look at cash, which are the 3 basic asset classes, and you can add in alternatives. In this case, we're going to add in a real estate as an alternative. These different asset classes are different in that they have different financial instruments, and they behave differently in similar circumstances. So you get a blended return stream from your portfolio based upon these different asset classes. The idea of being diversified, not just in, as you mentioned, Casey, 3 different large cap mutual funds. That's not diversification because those investment managers, using the herd mentality that most investment managers have, they're all investing in the same stocks because they're all swimming in the same pond of large cap domestic stocks. A professional investment portfolio manager will look at the different asset classes and blend the portfolio together utilizing stocks, bonds, and cash plus alternatives. And these can also be broken down further, stay in the stock category, large cap, small cap, U.S. versus international. In bonds, you can break bonds down further by saying investment grade versus high yield or non-investment grade, long-term versus short-term. And then in real estate, you have commercial real estate, and you have residential real estate, and you have REITs, and you have limited partnerships. So all these can be broken down further in order to produce the return stream that you need for the required rate of return that a portfolio for an investor has. Diversification comes from utilizing different asset classes in different proportions in order to manage the risk of the portfolio as well as the return. So you want as much return with as little risk as possible in your portfolio, which creates a higher predictability or probability that your portfolio will be successful.
And just clarify on that, like you said, Casey, we see clients that have a bunch of individual stocks and might think that's diversified. Like you said, they could be all the same sectors. So whether they've worked for that company and have a high concentration or sometimes there's some emotional connection with some type of inherited stock. You want to make sure that you have no more than 10% of one individual stock, but you can kind of deleverage away from not only those individual positions, but also being over-concentrated within different sectors with having various mutual funds, whether they be at different companies or just all in the same asset class.
There's been a number of studies that have been produced over the years looking at the asset allocation relative to a return in a portfolio. And the first one was done by a gentleman by the name of Gary Brinson back in the mid-'80s. And he looked at several large pension funds and substituted the managers in those funds for the indexes that those managers are supposed to be imitating, and found that over 90% of the return of the portfolio of that pension fund was attributed to the asset allocation that the pension had rather than the returns that the individual managers had that were selecting stocks. So simply by utilizing the indexes, in this case, in this study, you could expect to receive over 90% of the return that the investment managers had simply by investing in the index rather than stock selection. So it's very important to look at your asset allocation and diversify as much as possible within those primary categories: stocks, bonds, cash, and alternatives.
So there's a great chart out there called, I call it the quilt chart. It shows the different ways that asset classes have performed each year. Usually some of the top ones at the year, the first few years, are towards the bottom at the end of the year. So it's tough to pick really which ones are going to succeed for those years. And that's the whole reason to have diversification.
Another way you look at diversification, if you don't understand what large, mid, small cap is necessarily, think about it in terms of options. So you have 4 options in a portfolio. Option 1 is going to give you an 8% rate of return, but it's going to jump up and down by 15%. So it could be 15% higher, 15% lower. Maybe option B is going to give you a 12% rate of return, but it's going to jump by 25% higher or lower than that. Option C might give you a 6% rate of return, but it's going to jump up and down by 5 or 6%. And then option D is going to give you a 3% rate of return, but only move up and down by 2. And you have to get the mix right between options A, B, C, and D in the portfolio so that when you're watching the portfolio, you don't get overstressed on its performance. No one gets stressed about upside necessarily, but certainly to the downside. How much downside are you willing to take is how you should build that portfolio. So let's shift gears a little bit. Brad, you touched on it already, active versus passive. So I'll give you a hint. These 4 ETFs that we're talking about today are all passive. They don't have active managers picking and choosing funds. I'm a firm believer that active management doesn't win over the long term. When you're managing money for clients, the end game is 95. We plan to age 95 or greater. And if you're planning to age 95, that's a long run. There's never really been an asset manager, an active picker that has exceeded the indexes, the average market rate of return over that time period. There's academic studies showing you have a 99% chance of beating active managers over a 25 plus year period. So in the end, there are some very good managers out there, but you pay a premium for that service. So instead of paying 0.007% for fund fees that trade for free, you might have to pay a few percentages just to buy the investment each time. And then you might be paying over 1.5 or 2% per year in fees. It creates a drag in the performance. So there are good managers, but the problem is the fees associated with them kind of handicap them to the index. And there are cases where active management might be better for maybe emerging markets, or maybe it's better for small caps, or maybe it's better in bonds at times. But we've done all that research. And while there are some outlier funds out there, the long term is still very, very sketchy. And so I still believe that in the short term, let's keep our costs as low as possible. Let's be very diversified and participate in the average long-term average return, because that's what nobody can exceed over that time period.
Well, the thing about active managers, and you're right, there are some that do have periods of outperformance, is that they all have a certain preference, or I'll use the word bias. There are those active managers that have a tendency to overinvest in certain categories, and that at the same time, those categories are being rewarded by investors, and so they have extreme outperformance. But then when that runs through the cycle, they're still investing in those categories, but investors have moved on to other categories. And so you have extreme underperformance. So the swings in active managers can be higher and lower than an index. And the reality is when you're buying the index, you get those waves, if you will, of performance in the index already. You don't have to search for them. So if technology is taking the lead, it's in the index. If consumer discretionary takes over the lead, it's already in the index. This year we've seen energy take the lead. It's already in the index. You didn't have to make that call as an investment manager. You're always guaranteed to be invested in the best performing sector of the economy when you're investing in the index itself.
That's why you got to be careful with the active funds, is a lot of them will send out a lot of marketing materials that are focused and cherry pick the time periods or the fact that could have been a recently started fund, or just based on the time period and the sectors they're invested in, will cherry pick returns and send out very nice marketing materials that show great returns. But when you actually dive deeper into see the costs as well as how they've performed versus other benchmarks, it's not as good as it looks a lot of times. So you really have to do your research on that sometimes and not just go off numbers that you're provided.
Let's take that a step further. We could have a 5-hour dissertation on active versus passive and get into the nuts and bolts. We'll save that for another day. But let's talk a little bit about behavior a little bit. We have our own inherited biases in our investing, and so much is based off of how we feel. And in fact, people say it, they don't even realize it. They say, hey, Casey, I feel like the market's at a high right now, and I feel like we should be getting out and or making changes in my portfolio. You might be able to look at the market and go, yes, the overall market is high, or my portfolio has never been higher than this amount. That is a very straightforward, easy to do calculation. However, the next part is how I feel about what I should do next. Is it going higher? Is it going lower? And this is where investment behavior kicks in. And actually, for most majority of investors, their own behavior typically reduces their rate of return. Most people should have a higher rate of return than they do, especially the do-it-yourselfer investor, because what they're doing is they're making changes, or they have their own biases in how they build that portfolio. What do? We remove those biases. We have a program. There's math behind it, I guess, obviously. But when Brad sees our portfolios, a section of the portfolio is 5% higher than it's supposed to be, what do? We sell it. We take the gains and we invest it across the rest of the portfolio. What do we do during the COVID crash? The market was down 30-something%. Individual investors, many of them didn't move, according to a report to Vanguard, which is great. I think it just happened so fast they couldn't move, but they didn't make any big changes. That was the right thing to do. But it's still, we meet people who say, oh, well, I had cash on the side, I was going to invest more. Oh, I didn't rebalance. And so what happened was we had a 32% drop. It was a scary time, but what happened? Well, our stock was way under 5% of its target allocation in the portfolio. We ended up selling the bonds, which had gone up significantly because people were panicked, and we bought stock. And when we did that, we rebalanced our portfolio and we added a 3% rate of return for the year across the board. That is like systematic, automatic investing. We did. Yes, there were emotions about it. Yes, we talked about it internally going, I don't know if today's a good day to do this or tomorrow's a good day. The bottom line is it was down 32%. It didn't even matter what day it was, other than we had 1,000-point moving days, right? So individual investors have to be very careful that they're sticking to a plan. They're executing a strategy in their portfolios, and it's not based off of emotion. And even more importantly, we just talked about it in our 5 and 20 on our YouTube channel. Even the people that you see on TV and the analysts that you read, they have their own biases in choosing things. And a lot of times the person who sounds the most confident about their market forecast statistically is the most wrong. which I was like, what? Let me read that again. Where the person who is making forecasts, but maybe they're a little unsure, but they're always revising. If you look at their calls in the past, they're the ones that actually end up being more accurate. For us, thank goodness, we don't have to rely on forecasters in how we invest. It's fun to watch. I never want to be confused with Jim Cramer. So I'm very careful not to be confused with Jim Cramer, in that, we have a buy or a sell. That's entertainment, and that's great, but that's not how you should be investing, especially retirement money. That's your play money account.
Well, investor bias exists in all ways, shape, forms, and manners. So it's interesting. This also goes back to when we see investor portfolios. It may be $1 million portfolio, but they got a recommendation to buy a stock, and so they allocate some money to it, and they buy 100 shares. 100 shares of a $20 stock is $2,000 over $1 million portfolio. It could double, triple, quadruple, and it doesn't move the needle. Part of portfolio construction is taking large enough allocations where they're meaningful and that the returns can work in your portfolios so that it's enough to make these money. So we tend to have fewer securities, but we have larger positions in them, and we allow those allocations to go through the expected return scenarios in order to produce the required rate of return that the portfolio was intended to have.
Yeah, I think it goes back to behaviors are a big issue here, and why people underperform indexes or even active managers, just because they're getting their emotions in the way and making bad decisions. There, two of the biggest biases are recency bias. That's where you place greater importance to recent events. So as the market's performing very well, you're buying a bunch during a bull market, but then in a bear market, you don't buy when you should be, or you're even selling. And then overconfidence. There was a study I thought was pretty interesting that 81% of business owners think they have a chance of succeeding, but actually only think 39% of their peers do. And 93% of drivers rate themselves as in the top 50% of the driving quartile in skills. So obviously that's not possible, but people have overconfidence sometimes in their abilities, and sometimes it's just better to just diversify and not try to outsmart somebody.
I was at a conference one time, and a statistician was talking. He asked everyone to raise their hand. They thought they were a good driver. And of course, like 95% of the room raises their hand. It says, this is a room of like 2,000 people. It says they're good drivers. And he says, well, statistically, 60% of you are all going to be in accidents. So that's impossible.
Exactly.
And he was talking about a bias, everyone's own bias, and how they determine things, which was very interesting. Well, you know what? I don't want to keep us from the top 4 ETFs that should be in your portfolio. So Brad, once you break these down for us, these are 4 ETFs. This is what I would call a core portfolio. So honestly, you could go from $1,000 to $100 million, and you'd be just fine. The $100 million one, people look at you funny. There's no doubt about that. But you beat most active managers with these 4 ETFs. So Brad, why don't we assume it's like a moderate risk portfolio? So we need to have about 40% of our assets in bonds and 60% in stock. So let's start with the top. I always like to organize things by the largest companies to the smallest, foreign, and then alternative, and then bonds. So what's our first ETF, Brad?
Well, the first ETF for this portfolio, we're looking at the United States stock market. And so we looked at one that tracks large companies, mid-sized companies, and small companies all in one portfolio in order to gain the greatest efficiency in that portfolio. So we're looking at an ETF called the Vanguard Total Stock Market, symbol VTI. VTI. It tracks large companies, small companies, mid-sized companies, and small companies, all at a total cost of 3 basis points or 0.03%. It holds 3,700 publicly traded company stocks in it. So you're buying essentially the entire U.S. stock market.
That sounds very efficient to me. And in fact, if you guys remember, when we were all picking our best performing stocks or ETFs for 2021, VTI was my pick.
Yes, it was.
So I'm not sure where we stand on all that. I have a feeling I might be in the lead.
You may very well be. It's market cap weighted, so the largest companies are going to have the largest weighting in there. Microsoft is the number 1 holding, followed by Apple, Alphabet, which is really Google, Amazon, which we all know about, Facebook. So all those right there are all technology. So technology also has the highest weighting in the portfolio at 25%, followed by Berkshire Hathaway, which is the Warren Buffett company, JP Morgan Chase Bank. Tesla made it after being admitted to the S&P 500 late last year. Johnson & Johnson Pharmaceutical, and United Healthcare in our healthcare group. So all well-known companies, all market cap weighted. So you're getting your portfolio weighted in the exact same manner that the marketplace is weighted. And again, at a very, very low cost. A great way to get exposure to large cap, mid cap, small cap company stocks in the U.S.
So we have VTI, which covers the United States stock market, but we can't put all of our money here at home. We need to take a healthy percentage and allocate it to foreign developed countries as well as foreign emerging markets. So we kind of have the same concept. We have an all world, not including the United States fund. Why don't you tell us about that one?
Right. Here we're picking a ETF that tracks the FTSE All World ex-US Index. FTSE is the Financial Times Stock Exchange index, and it covers everything, all companies, publicly traded companies outside the United States. Large companies, developed countries, mid-sized companies in developed countries, and it includes emerging markets, both large companies and mid-sized companies as well. Very broad exposure. It has an investment management fee of 8 basis points or 0.08%. And we have that weighted in the portfolio at just under 14% to get exposure to those marketplaces.
What are some of the top companies in there?
A lot of these you're probably not going to know as an investor. Let me try this. Let me say where it's invested first, the top countries. Okay, so Japan has a 16% allocation in this fund. Hong Kong, 11% of the money is invested there. 10% is invested in the United Kingdom. France, Germany, Switzerland all have between 5 and 6%. Canada's got 5%. Australia's has 5%. Taiwan's around 4%. And Korea has about 4%. We're looking at, these countries outside the U.S., broadly diversified in their marketplaces. Some of the larger holdings don't have quite the weighting in the portfolio that the U.S. Stock ETF has. The largest holding is at 1.68%. It's called Tencent Holding, which is a company in China. Alibaba is also in China, has a 1.45%. Nestle, which is a very well-known company, I believe it's in Switzerland. Taiwan Semiconductors has a 1%. So, and it gets smaller from there. So these are companies that are operating outside the U.S., serving the global marketplace, all in this portfolio, trading in exchanges all around the world at a very low price of 0.08%.
All right. So we have the United States covered. We have the rest of the world covered just in 2 funds, low cost, trades for free on most platforms. Now we need to move into what some would call an alternate category. And I think this is important because, you need some exposure outside of just traditional stocks and bonds. And so I like seeing a little bit of real estate added to the portfolio. We have a kind of a go-to real estate allocation for publicly traded real estate. Brad, why don't you tell us about that?
Yeah, this is an iShares product. It's called Global REITs. So these are REITs, real estate investment trusts, that trade throughout the world on exchanges. We have global diversification. A real estate investment trust is by nature has to pay out approximately 95%, I believe, of its profits to the shareholders. This one has a very low cost as well. I have to look this up real quick, but it gives us a broad global exposure into the alternative investment space. So when we talk about alternatives, it's not just alternative investments at all. So it's a non-correlated return stream. So if stocks are up, real estate may not be performing as well, but we're seeing that real estate recently has done quite well relative to stocks. So it has these non-correlated return streams that fill in your portfolio's return, during other times. So we're looking at diversifying not just the investments, but the returns from those investments. So the U.S. stock market, the international stock markets are non-correlated, and real estate is non-correlated to equities.
That's great. And I'll note here too that REIT, you think about real estate, office space not being used as much because of the pandemic. But in reality, that some of the top holdings are actually public storage, not necessarily commercial office space.
Yeah, and of course, we're also seeing a lot of work in the area of these giant warehouses that house certain goods that are bought online and that are distributed throughout the U.S. And so for early delivery, you may buy something that is housed in a warehouse in Atlanta. If you're in the Southeast, you may receive it from there. Versus if you're in Los Angeles and you buy the same product, you may receive it from a storage facility that's in Southern California somewhere in order to receive it. And those are very large warehouse REITs that you might find in this ETF as well.
So we've got the world covered in 2 funds, and then we have real estate. Let's talk about bonds for a little bit. First of all, why do you even need bonds in a portfolio? Because I thought everyone tells us bonds are bad these days.
Well, bonds themselves are not bad. The yield on bonds today is lower than we've seen in many, 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 many years historically. But bonds themselves mitigate the risk of the volatility in stocks. So bonds are added to portfolios today in order to mitigate the risk, to give you a higher certainty of the return expectation in the rest of the portfolio, along with some income. In the past, when we saw interest rates, up around 6-7%, like we saw 20 years ago, they also produced and had an income return associated with them. Today, the interest rate that you're going to get, or the yield you're going to get on bonds, and especially investment grade, is much lower, 2%, 3% maybe if you're fortunate in a portfolio. But really, you're adding bonds in order to mitigate the risk and the volatility of stocks on the portfolio.
You mentioned diversification earlier. Going back to the bonds versus the REITs. I mean, REITs were down over 42% during the pandemic crash in March 23rd, but they're one of the highest performers over the last year at over 32%, while bonds are struggling a little bit. REITs are a good diversifier when inflation increases as a hedge for that. So you're not always trying to pick the biggest winners. You're trying to diversify, and over the long term, it works itself out.
That's right. And REITs also have that income
them
component that are from the rents that are being paid for the storage space.
I like calling them long-term healthy asset classes. And long-term healthy asset classes always make money over a 10-plus year period, but they go through cycles. And that's true of sectors, but we're not really investing in sectors here. We're just looking for broad market exposure. But yes, there are times when VTI will be outperforming VEU, and there's times when VEU will outperform VTI, and then there's times when REIT will outperform it all or underperform it all. And it's the same for bonds. Bonds will go through periods where they aren't performing the way we would like them to be. Obviously, we like to see a 3 or 4% rate of return for bonds each year and a 5% yield, and that's not going to happen going forward. But when the world seems to be falling apart and because a black swan event happens, those bonds are what you're clinging to. They're the life raft. They're what I call the insurance of the portfolio. So there are a lot of different ways to cut and slice bonds today. I think the simplest way for most do-it-yourself investors is to buy which fund, Brad?
Well, this is a Vanguard product called the Vanguard Total Bond Market, and the symbol is BND, and it attempts to imitate the total bond market in the U.S. of investment-grade issued bonds. So you have a lot of treasuries, U.S. government agencies, and you have investment-grade corporate securities in there, corporate bond-issued securities in there.
It's an entire U.S. bond market, really. I mean, you can't get more diversified than that. Again, it's when you have gains during crises, you take those gains and put it back in the stock, which would be underperforming. So there you go. There are 4 ETFs that give you a complete portfolio. And you can slice it and dice it how you want, depending on how much risk you want. If you want to be an aggressive investor, then you would tilt more toward the VTI, VEU, a little bit in REIT, and then maybe only hold 10% in bonds. If you want to be a very conservative investor, you might bring 60% would be in B and D, and the 40% would be slice and dice between VTI and VEU and the REIT fund. This is the very basics of how you would build an allocation using 4 low-cost transaction-free ETFs. Obviously, how we manage money. Sometimes we use portfolios very similar to this for accounts less than $50,000. But then after that, we bring a little more sophistication, a little more style picking to the portfolios, and it has added benefit for sure. But sometimes we go through short periods where this basic portfolio outperforms everything. And so that's why I said at the beginning, you could put $100 million in here. People might think you're crazy, but you could do it, and you'd be just fine long term, as long as you had good behavior, as long as you weren't making changes to the portfolio based on how you feel, and you were just focused long term. And as always, you want to make sure you have cash reserves on hand, so you don't ever have to go into your portfolio should an event happen in your family where you had reduced income.
Well, you talk a little bit about returns. This portfolio in a 60-40 allocation, 60-40, remember 40% is invested in bonds. We talked about how the low return expectation that we have for bonds and have had for a number of years. So, but a 60-40 has averaged over 8.5% per year over the past 10 years or so. When you look at and think about the rule of 72, where if you take any given interest rate and divide it into the number 72, it gives you the number of years it takes for money to double. So at 8.5% over the past 10 years, you'll have doubled your money at a very low cost to do it, in a very simplistic manner with broad exposure to all major asset classes and a very low cost. We talked about these 8 basis points for the international equities, 3 basis points for U.S. equities, 4 basis points for your bonds, and 14 basis points for the real estate. These are very, very low cost ETFs, giving you very, very broad exposure and a very good return.
Not necessarily the water cooler topic. It's not the Tesla. It's not some fancy tech sector ETF. But this is certainly going to get the job done. And I would argue it's going to get the job done better over the next 10, 15 years than any of the hot ETFs that get talked about on a daily basis in our industry.
Yeah, without a doubt. And one of the biases that, we were talking about is, recency, but recency also in the latest stock pick that people get that like to talk about around the water cooler, as you mentioned, Casey. So yeah, Tesla had a great year last year. It's kind of fallen off a little bit. Again, we're not looking at individual, stocks here to talk about it, the water cooler. We're looking at a portfolio to fund the rest of your life for people who invest with us. And that's what we're looking at. We're looking at, how are we going to have the highest probability of building a portfolio that's broadly diversified, that gives you the best opportunity to fund your goals for the rest of your life. And it's through allocations like this that we may break apart a bit, but they're based on this concept of portfolio construction that has worked well for us and for our clients.
All right, guys, enjoyed the conversation, and we'll see you next week.
Thank you.
That sounds great.